Greetings, everybody. Welcome back to our portfolio management series. Today, we're going to find out if you are truly diversified or if you are fakely diversified, if fakely is a word. We're going to be using a free tool, and I'm going to share my screen here and get you dialed in with that. This is a quick and dirty exercise on how you can look at your own portfolio to see if you truly are diversified. And when the stuff hits the fan during the next market cycle or downturn, you'll have peace of mind knowing that your portfolio is diversified, you have assets that complement each other. And what I always tell people, it doesn't do you any good to own 30 different assets if they all act the same during times of stress. And I'll show you what I mean. So let's get into my screen. So I'm on a website, you can see it here, portfoliovisualizer.com. So just like this says, portfoliovisualizer.com. Again, this is a free tool. And what we're going to be looking at is how your assets move in relation to each other. And there's a couple important points here. One, these relationships do change over time. So I'm going to be looking at a time period where the market saw a lot of stress. So back in the spring of 2020 during the COVID sell-off. And then we'll be looking at 2021, which thus far it's been one of the calmest years on record. And you can see the differences in how your assets move in relation to each other. And as a general rule, during times of market stress, asset class correlations tend to move towards one, which simply means they'll be moving together. So looking at correlations, one means two assets move exactly in tandem, okay? An asset class correlation of 0 means there's no correlation. So asset A goes up, asset B might go up, it might go down, it might stay flat. A negative correlation, a correlation of -1, means if asset A goes up 10%, asset B will go down by 10%. So with that context, all I've done here, again, is looking at a period of stress, so 1/1 of 20 to 5/31 of 20. And I've got a few things on my screen. So what I've done here is just throw in a bunch of random asset classes. So we have the S&P, mid-cap stocks, small-cap stocks, developed country stocks, so larger countries like Canada, Australia, Greater Europe. I know that's a continent, but all of those countries as well. Emerging markets, basically a proxy for the US bond market, US treasuries. We've got some corporate bonds in here, real estate, gold, and commodities, okay? And then you can also see the daily standard deviation of each one of these ETFs. So how much these ETFs moved within a day. The higher the number, the more they moved. So we have daily, monthly, and annualized. And as you'll see, when we flip to 2021, a lot of these numbers here are elevated, okay? So again, the higher the number you see here, the more that asset is moving, which can be a good or bad thing. So a couple things stick out here. One, I find people tend to look at assets in a silo, like gold, for example, very polarizing asset class. People might think gold is good or gold is bad, and I think that's the wrong way to look at it. You want to understand how gold either adds or detracts value within your total portfolio. So look at assets within a total portfolio context rather than in a silo. And there's a few time-tested ways to hedge risk. That is cash, gold, and US treasuries. The benefits might ebb and flow. Like during some recessions, gold might really add value. Like 2020, gold was a superstar. It was up like 20-something%. In other years during a recession, gold might not be as favorable. But going back through various market cycles, gold, cash, and US treasuries are a great time-tested way to hedge your biggest risk. And in most cases, your biggest risk is your equity exposure. So looking at this matrix, you'll notice a lot of the equity asset classes, including gold. So let's just look at this first line here to keep it simple. So this is the S&P 500, ticker IVV. And you've got the S&P 500, ticker IVV. It would make sense, since it's the same thing, that this is a correlation of 1, right? It's the same asset, so it's going to move together. But look at how the S&P moves in relation to mid-cap stocks. It's almost 1, so it's moving very closely together. Same with small cap stocks, moving very closely together, almost 1. Same with foreign stocks. Same with, okay, so this is foreign small cap stocks. Look at emerging markets relative to the S&P. So these correlations are very elevated. And you can go on down the line looking at corporate bonds, looking at real estate, look at gold, look at commodities. these are all very correlated to the S&P. And again, this is a period of stress in spring of 2020. So if I'm looking at this, owning different flavors of equity didn't really do much to mitigate downside risk during this period, which is not necessarily a good thing, but it's actually an expected thing because, again, correlations tend to converge to one during times of stress. Now, another thing that sticks out here, I know bonds catch a lot of flack, especially U.S. Treasury bonds. I'm told time and again, yields are so low, these bonds aren't really outpacing inflation, I'm not generating any income, why should I own these? Let's just pile it all into equities. Well, spring of 2020 is why you own high quality bonds. And again, if you look at some of these figures, these are short-term treasuries, these are longer-term treasuries. You can go down here, see TLT actually was negatively correlated, and these are intermediate here, this IEF. So you look at these three, short-term, intermediate, and long-term treasuries, they truly acted differently than equities. And if you owned some of these high-quality bonds, they did a great job of mitigating risk. So let's scroll down and to the right. So I don't have returns on here, but rest assured, U.S. Treasuries were a star as far as mitigating total portfolio risk, right? We're not looking at assets in a silo. We're not saying bonds are good or bonds are bad. We're trying to understand how bonds add value during times of stress, and they certainly did in 2020. So now that we've got that picture, keep a mental note of these elevated standard deviation numbers. The higher the number, the more the assets move, the more risky they are, and then how a lot of these equity allocations converge to one, okay? Now we're gonna flip to 2021, which again has been a pretty docile year, despite comments to the contrary. So we're gonna fast forward a year, 1/1 of 2021 to August 31st of 2021, and watch how these numbers change, okay? So the first thing that sticks out, the standard deviation numbers are much lower. So this has been a very docile year as far as equity market movement. It's been a slow melt up since the start of the year, which really is a characteristic of a bull market. Bull markets aren't meant to whipsaw higher and then whipsaw lower and then whipsaw higher. The sign of a healthy bull market is actually a steady melt up, and that's what we've seen in 2021. The second thing that sticks out, if you recall, during the previous period, a lot of these correlations converged to one, meaning the S&P was moving the same as mid cap, small cap, emerging markets, international stocks. Look at the correlations now. These are all over the place. Look at emerging market stocks are actually negatively correlated to the S&P 500. So if you're looking for diversification benefits for your equities, you're essentially getting that in 2021. Bonds are still negatively correlated, but less so, and actually longer-term bonds are modestly correlated to the S&P. Gold essentially has zero correlation, the same with commodities. So there's a few important points here. One, if you're working with an advisor or you're doing it yourself, you need to understand the relationship between the assets that you own. And as you can see, these relationships change over time, okay? As a general mental shortcut, correlations are going to go up, meaning your assets are going to move together during times of stress. During times of serene market conditions like 2021, it's going to be a little more scattered. The other point I want you to take away from this is don't look at assets in a silo. Don't think bonds are good or bad. Don't look at assets in isolation. Understand how they work in the context of your portfolio. And the question you're trying to answer is, am I diversified? So go on this tool, go to portfoliovisualizer.com, run various time periods to see how your assets acted together or differently during times of stress. Again, it doesn't do you any good to own 50 different assets if they all act the same during times of stress. So this is really portfolio management 101. You need to understand how the assets move in relation to each other. If you're working with an advisor, they should be able to tell you this. They should be able to track your portfolio journey. I know we all obsess about performance, but risk in the context of performance is what we're really after. So let me know what you think. Get on the portfolio tool. It's free. It takes less than 10 minutes. Understand if you're really diversified or not. These are things that you can do before something happens to give yourself a better opportunity to stick with your long-term investment plan and to mitigate downside risk. Thanks for checking in. Feel free to respond with comments or questions or click on the link in this video to schedule time to talk to your portfolio. Thanks.